Hey there, it's Chris Richards with the Richards Mortgage Group. Today I'm going to make a quick video in our mortgage math series. The purpose of this series is just a quick introduction to math items as they come up. Usually during my day something comes up and it triggers me to make a video. The trigger today was a client calling me who's looking to purchase secondary property. He currently lives in Vancouver. He's trying to buy a property on Vancouver Island. And what he's discovered is that his current mortgage is prohibiting him from making the necessary changes he needs to make in order to qualify for this next purchase. And what's inhibiting him is he's currently in some mortgage product that has an expiry date in 2023, so just a couple of years out. And he's in a mortgage with one of the big five bank lenders. And the challenge that we have with the big five bank lenders in the mortgage world is they've got great product selection. They're often very competitive on rate. For borrowers, they seem to be the default. If you bank with, TD or Royal Bank or Scotia, whatever, it seems to be the easiest method to get a mortgage approved for some people. They don't realize what the other non-bank lenders might offer. And one of those areas is what's called the payout penalty calculation. When you contract to borrow money on a mortgage, let's say a 5-year term, and let's say 3 years down the road, a circumstance comes up where you need to break the mortgage or need to consider breaking the mortgage, as is with my client, and there will be a payout penalty calculated. And I always say to people, it's not if you'll make a payout penalty, it's when you'll make a payout penalty with any bank with any closed term loan. So in a closed term loan, you're committing to the lender to be with them for a period of time, let's say 5 years. If you don't, you have to pay a penalty. The only way you can avoid a payout penalty with a bank is if you pay out your loan exactly on the maturity date. If it's outside of that maturity date and you have what's called a closed term loan, as opposed to a closed term loan, there will be a penalty calculation. So the challenge then becomes for you is, how do I minimize this payout penalty when the time comes? So in this video, I'm going to quickly just illustrate to you two different ways of calculating the penalty. One will be the big five bank method, and the other one will be what we call monoline lenders or other lenders available in the broker channel, how they'll calculate it. So keep in mind, the main point is it's not if you will make a payout penalty, it's when. So if you move your house, if you move from one location to the other and you have to discharge the one mortgage and get another mortgage, that's breaking the mortgage contract. If you want to pay out your mortgage and you're not doing it exactly on the maturity date, then you're going to pay a penalty. So let's have a quick look at the calculations. Okay, so let's just have a quick look at the actual math behind payout penalties, just to illustrate what's called the interest rate differential calculation. That is the term IRD, that's the term that banks use when they're calculating your payout penalty. And I can guarantee you, on banks' profit and loss statements and their profit section and all the things that banks do, they have a line dedicated to the amount of revenue that they can generate on payout penalties. So let's get into this quickly. And by the way, if you enjoy our videos, please remember to press the like button and subscribe to our channel. So let's have a look. If you end your contract early, you will have a contract break penalty. And this is the logic behind the payout penalty. If you contract with a bank to give you a certain amount of money, let's say at 3.5% for a certain time frame, they might take on a deposit, a GIC, or somebody puts money into the bank. Maybe they pay them 3.25% and they book a 0.25% difference, and that's their profit. So that's how banks manage. It's called a spread, and that's how they manage profit, is managing that gap. Now, if the market falls and now the rate for mortgages has fallen 2.5%, for example, they're still obligated to pay the deposit certificate, in this example 3.25%. So what banks are trying to do is preserve their profit margin not so much the actual interest, but the difference between things where they borrow money and lend it back out. So let's quickly look at this example. So most of the big banks, CIBCs, TDs, Scotias, Royals, national banks, they have this terminology called a discount to post it. And I'm going to go to some examples in just a minute. But in this example, I'm going to pretend that you had a 5-year contract, you're 3 years into that contract, and as is my client in Vancouver, he needs to consider breaking that contract in order to execute his next financing plan. So in this example, I'm using where we have $300,000 currently owing on a mortgage. There's 2 years remaining in my mortgage contract. The contract that the client signed 3 years ago was for 3.5% interest for a 5-year fixed rate term. Now here's what the banks do. The big banks maintain posted or rack rates. And you talk to the bank and say, oh, we're going to give you a discount because you're a valued customer. No, that's not the case. The discount is off these posted rates that the bank manages and manipulates in order to get a profit number onto their bank profit and loss statement. And I'll illustrate that in just a couple of seconds, what that looks like. So in this example here, what I want you to notice is that they offered you a contract 3 years ago at 3.5%. At that moment in time, their posted rate was 5.25% in this example. And so out of the goodness of their heart, they gave you a 1.75% discount. Sounds great, sounds harmless. So let's look at another type of mortgage lender that's very prevalent in competing in the Canadian mortgage space. Same opportunity 3 years ago to lock in. They were offering a similar mortgage rate, but they don't run a different set of interest rates. They simply say, this is our posted rate, this is the rate we're offering. They're not running two curves. And so as a result, there is no discount to the rate that they're offering. So let's go and have a quick example. I'm just going to walk you through two rate sheets that we get. This one's from a big bank lender, and this is a cutout from what we call a monoline mortgage lender. Somebody who has what I call a more fair payout penalty calculation. So you can see in this column here, you've got the bank who is posting rates. And we'll look at this rate here, for example, 4.79%. They're offering to customers today for a 5-year contract, they're actually offering 2.74. That's their competitive rate. So this is the discount that they're giving you, and I'm going to show that in 2 seconds how that comes into the math. So they're giving you a discount of 2.05 off a table that they create, which has no relevance to the mortgage market. Now, here's a monoline. They say our posted rates, but as you can see here, that it's a different format. But what you can see down here is this last line here is the comparable to this column here. Their 5-year rate is 2.49% versus these are both produced today versus this lender's 2.74%. So just a plug for mortgage brokers. All lenders are offering rates, and there are variations in the rates, and so a mortgage broker will shop the market and tell you who's offering best rates, apples to apples. Now, a lot of lenders, the IRD penalty calculation is not apples to apples, and so while you might get a better offer slightly from one lender or the other, always ask the question, how is the IRD or the payout penalty calculated? So let's just quickly compare 2.49 to 2.74. Their 4-year is 2.34. They're offering 2.54%. 3-year, they're offering 2.34, 2.39. 2-year, this lender's offering 2.34, and this lender's offering 2.34 as well. But notice their posted rates are the rates that they're offering. There is no discount. So let's go back and see what happens. So in my example, I was saying 3 years ago we had 3.5%. The posted rate at that particular time on that column was 5.25, and the discount they offered when you first applied was 175 for what seemed like an equivalent mortgage rate offer. With a different lender, a Monoline, there was no discount. So let's fast forward to today. You need to break the contract. What this big bank lender is doing is they are going to use the discount from 3 years ago, and they're going to compare it to the rate they are showing today. So their rack rate today, 2.89%. So they're comparing the discount off this rack rate, and this is a number that they manipulate, it's not a mortgage rate, and they come up and say the interest rate that we're going to use in this calculation, this is all we're going to get if we relend your money. If you go away and we have to relend your $300,000, all we're going to make is 1.14. Whereas this lender doesn't have a discount. They're simply saying, you know, if you go away, we can relend our money at 2.34%, no discount. So that's the number they use in their calculation. So now in an interest rate differential calculation, you take your original contract rate minus the replacement loan interest rate. So the big bank is calculating 1.14. The Monoline is using 2.34, just what they're showing on the rate sheet, and they come up with an interest rate differential. That calculation is now 2 years remaining term times $300,000 that you owe them times the interest rate differential percentage, and there's your penalty. So you can see there is a massive penalty difference between a big bank with discounted rates used in their IRD calculation versus what we call monoline lenders who don't run posted rates and these deemed discounts. So when you're choosing a mortgage lender, be very clear that when you go to pay out your mortgage, the only time you're not going to pay a penalty is when you pay it out exactly on the maturity date, or naturally pay out your mortgage through the payment privileges that you're allowed. Other than that, they're going to look at what do you owe us, how many years remaining in your contract, and they're going to do some math. And so when you look at that difference in payout penalty, that's massive. And so people get confused, and especially when I get calls, you know, what's the rate? There's so much to rate, and there's so much to a mortgage calculation. You have to understand this part as well. So I hope you enjoyed the video. If you like getting down and dirty with mortgage math, then I'm more than happy to help you really dive into the numbers and understand what's going on. If you would like to have a conversation with our group or get pre-approved for a mortgage, happy to help. What you see is what you get. This is Chris Richards with the Richards Mortgage Group. Looking forward to talking with you about your mortgage needs.